Let's move on to the equity side. And as per usual, let's start with earnings and earnings expectations.
Yeah, sure thing, Rick. And sub 2% inflation, those were the days, were they not? Yes, crazy. We can only go back. Now, there's no shortage of things to talk about in my world in the equity space, and I'm going to kick things off with what I think are foundational earnings and valuations. We'll go first with earnings, Rick. As you see on the left-hand side, earnings expectations for the S&P 500 continue to ratchet higher. It's been a company which, to me, if we can maintain that, that's a good mix. You got cheaper valuations, you've had multiples contract, and you continue to see earnings revisions going higher. Now, a lot of that what we're not showing is driven by what you would expect. Semiconductors, getting the data center build, we're seeing some pickup, shocker, in energy, in terms of energy earnings revisions, materials, industrials. A lot of these old economy sectors, I'm going to put a pin in that because I'm going to come back to that later. And if we do hit these earnings, these are going to be some of the strongest two-year earnings growth that we've seen outside of a post-recession period. Fingers crossed, but the one thing I will say is typically there's a 2-month lag, right? When we're in a one variable market like we're in, between the time now where earnings peak and where they start reducing earnings revisions. We saw that in 2022 because everybody was focused on inflation. We saw that last year. This is deja vu all over again. No shortage of fun things happening. We were talking about tariffs about a year ago today. So there is a lag. That's the one thing I would point out as a caution. But Eric, to your point, if this gets resolved quickly, I think the markets will look through that, even if earnings get taken down a bit. Valuations, another good thing to speak about. It's painful as you're getting there, but when we have this conversation at the beginning of the year, I know Nelson joined you, but we were at extended valuations by any measure, historically, as we do on the table on the right. It's nice to see that they have pulled back into roughly 19 times forward earnings. That sets us up for better expected returns as we go out. Not to mention a better entry point if things progress as we expect.
And for whatever it's worth, by the way, if you look down those lines, that puts us more or less in line. If you look a little further down with December 2023, the pre-pandemic, and the 10-year average, it's more floating around where it was.
Right.
So it's a little bit of a relief from a valuation standpoint, and something more in line with what we've seen for longer periods.
Yeah, selectivity is still going to matter. It's not a massive back up the truck moment, but nonetheless, better turn of trade, to be sure, where we came in at the end of last year. So if we do a deeper dive, Ricky talked earlier about the index returns. On the left-hand side, what stands out is, surprise, surprise, low volatility equities, as well as value equities. Value equities, just as a reminder, that's a shorter duration type asset class because people are valuing the bird in the hand and the cash flows that they get from value equities. Conversely, growth equities lag. There was a massive style reversal, and that value has led across the board by style and region. And the other standout, but that's why I highlighted that bar orange, the Mag 7 became the Lag 7. It's not to pick on them. I will say we still own them in good measure in a lot of our portfolios. And they're still, despite a lot of the AI concerns, we still have conviction in a few of those names. What the headline number on the S&P 500 doesn't tell you is what I call, on the right-hand side, there was a subsurface correction, if you will. Roughly 24%, a fourth of the S&P stocks were either up 20% or down 20%. So the headline, negative 4.3, doesn't tell you the full story. And beyond just the war, what we have going on, which we hope we can wrap up, the one thing that won't change, if we go to the next slide, Rick, is what I call this AI disruption whack-a-mole. So I won't go through all these, but if you look at the first from the upper left-hand corner, this was a carryover from last year where we saw fears of the SaaS apocalypse, where application software, IT services in terms of consultants were like, oh my gosh, they're going to be displaced by AI or disintermediated. Then it went to software, legal, and information services, then to asset management firms, remember robo-advisors. Kind of doubt that that's going to be displacing financial advisors anytime soon. It can enhance productivity, trucking, logistics, and then I have, in terms of a hat tip to Mike Judge, I'm a fan of them. You see the King of the Hill graphic next, right? Who's next? My point is that this is something we're going to have to deal with, and being active in making a distinction between those companies that have competitive moats. If you're a software company and if you have a systems of record software where enterprises are not just going to rip that out, you have cyber concerns, you have compliance concerns. There's a lot of things you just can't displace that right away. And if people are taking code from vibe coding, that lowers these software companies' cost of goods sold. So you need to be very discerning here. That's not going to change. But part of what we saw at the factor level, and again, this was talked about last quarter, if you look at the left-hand side, these are classic quality factors in equity. And what happened last year is you saw a lot of the speculative growth companies shrunk, if you will, a lot of your high-quality stock indices and factors. That was still the case up until early February. And don't you know, what happens is the war is looming, people take that quality high ground, and those responded in kind. The question we get now is, if you're looking at moats with all this threat of AI disintermediation, what's a toolkit? What are some factors that you might want to consider for the road ahead? And that's what we're showing on the right-hand side. Effectively, it comes down to capital discipline and adaptability. If you have capital intensity, if you have property, plant, and equipment, and you have it running efficiently, and you're not leveraging up your balance sheet, typically that's going to generate a high return on invested capital. And as you adopt AI, earnings revisions start to go higher. That's what's worked well so far this year, and we think that that's a good playbook as we look ahead. So beyond factors, we've seen a lot of churn. I talked about that in terms of the upfront, where you saw the index returns at the style level. Now, it's a busy chart if you see, I call this effectively a Christmas tree bar chart on the left-hand side. But what this is showing is, what's staggering is over the last 5 years, style has shifted every 233 days. And if you compare that to 2010 to 2015, it took 700, almost 800 days for style rotations to happen. And I've been telling people, I've been on the road a lot, that I was going to make a T-shirt last year, and it was being called The Case for Core. Core is back, right? And we've seen that. We've seen value stocks participate, not only at the factor level, Rick, but if you look at the sector level on the right-hand side, beat the old boss, same as the old boss, right? A lot of these old economy sectors, remember that line that was during the internet bubble? They've had quite the comeback year to date. When you contrast that to how well tech and consumer services have done, it's a stark contrast. We're not saying it's over for tech by any means, but the notion of having multiple shots on goal and looking at these areas of opportunities, you talk about a lot in terms of deglobalization. We're seeing the AI disruption. There's a lot of ways to win here, and Core gives you a broader opportunity set in which to do that. Now, I referenced value stocks earlier. Last year, in the past few years, we've had a lot of concerns about valuation. Look, value stocks have re-rated higher, and that's what we're showing a bit on the left-hand side. But if we put it in the context of their growth counterparts, they're still trading at a 30% discount. And just because they're cheap, that doesn't mean that they're dull. Some of the themes that you see on the right-hand side, whether it is commercial aircraft manufacturing, more people want those experiences. Travel planes, I don't know about you, Rick, but all of them I'm traveling on are still full, right? So that's what happens with, when people are, there's just a lot of pent-up demand there. So the growth rate there, Eric, you talked about agriculture and fertilizer. The need for productivity there, especially now, is very, very keen. We list some others, but if you put a summation sign under a number of these themes that we remain highly convicted in and value, you're solid double-digit earnings growth at a discount. And with all these undeniable forces happening, again, having that mix makes some sense, and the price is right here.
Yeah, well, I mean, anyone that's listened to me talk on this or on the CMO or elsewhere knows that I've been talking about value for some time. And if we're thinking about the supply chain of AI, for example, so many of the elements exist inside of this, or we're going to have an energy discussion.
Yep.
Many of the elements exist inside of this, and it's only in the not too distant past that money has started to find its way persistently into value. It was sort of serially underinvested from the GFC on. So if we're back to your, it's still discounted by 30%, that's where it sources from. It goes all the way back to the GFC. But I have advised for quite some time that there are real opportunities in here. And if you'll forgive me, there's growth inside of the value index in areas like the one you're showing.
To be sure. And I would say a nice second cousin to that, lives in that value world on the next slide, are dividend-oriented stocks. The chart that you see on the left-hand side just shows how different dividend-paying stocks have outperformed what we call classic inflation hedges. This is especially the case as inflation moderates. And Eric, we talked about the notion that is our base case expectation. But I want to be clear, and this is pretty robust data. This goes back to 1971. Okay, this isn't looking at a lot of things. These are just risk-adjusted returns, and I caution people, don't reach for yield in terms of the high dividend payers. So if you look at that top bar, that's the second quintile. Think of that as the next highest dividend payer, not the highest. We want companies that are going to have that sustainability of a dividend payout, and more importantly, dividend growth. Because if you look at the factors in the middle, things such as shareholder yield, dividend growth is the key. Less so beta. And I was saying a couple quarters ago, enjoy the beta train while it lasts. This quarter has it, and these dividend stocks have shined. And again, we look at from a valuation standpoint, they're still trading in the 16th percentile of their historical valuation range, and that goes back to 1990. So more to come there in terms of gas in the tank, I would say. We talked on a number of quarters about a number of ways to go about thematic investing. And Rick, I would say one of the criteria that we adopt is it has to be investable. We think space is one of those themes right now that is investable. And the reason why, a couple metrics on that. In 2020, deal count in the space area went from roughly 400 deals to over 752 from 2020 to 2025. In dollars, it doubled from 45 billion to 92 billion. That's created a number of companies in which are investable in this area. And the chart that you see on the left-hand side is just effectively showing, and it's timely given the space launches that we've got going on right now. The space shuttle in 1981 cost over $85,000 per kilogram to launch it up. You fast forward to 2020 in terms of the SpaceX rockets that we show, it dropped to $951 per kilogram. It is one of our portfolio managers like to say there's PEs, but there's P over Q. As the price goes down, the quantity goes up. In terms of the number of things that we launched into space, it's gone from 500 in 2017 to over close to 3,000 right now. So a lot of ways to play that. And what we're showing is use cases by AI, by function on the right-hand side. There's been a lot of question marks. Are we in an AI bubble? I don't think so. We're still early stage there, and there's a lot of ways we could play this, whether it's through power bottlenecks that we've talked about before, or to utility companies, right? Some of the industrial companies that are benefiting from this. So I wanted to just highlight that as a fresher idea that we've just come upon, that we have high conviction there. Not to be outdone, lower volatility stocks, as I said, those shined. The good news, again, on the left-hand side, if you look at where low volatility stocks are priced relative to the S&P, still well below its long-term average. And in this environment where you can have a potential range of outcomes, Eric, as you said, you always have to have humility about these things. We're taking a balanced approach between companies who have pricing power. If we were to have a hard landing, and not a high probability event in terms of our view, areas like pharmaceutical, aerospace, and defense, where if price increase goes up or the economy really accelerates, some of the banking and some of the food retail companies, that's where we're finding opportunity there. I'll round things out, Rick, with international. We've talked about this. It had a good year last year, and it continued to outperform. And I think some of that is the fact that the earnings growth in international, when you look at the earnings growth on the left-hand side, it's competitive with the U.S. We show the S&P, we show S&P X Mag 7. U.S. is still robust, right? The exceptionalism still exists, but you have cheap valuations, you have competitive earnings growth, and akin to the value slide that we talked about earlier, we're showing areas of opportunity, which are very widespread here, from semiconductors to online gaming companies, commercial banks with very attractive shareholder yields, and electrical equipment companies that are benefiting not just from the AI build-out, but in some cases are selling to military defense contractors, as we're seeing NATO budgets increase there for defense spending. Last, from an opportunistic standpoint, another neighborhood that's been a good one to live in has been emerging markets, Rick. So what we're showing here is anytime on the left-hand side, anytime where we've seen the VIX have these spikes, we're just showing the subsequent 12-month returns, and we call out the things, the GFC, what happened during COVID, the European debt crisis in last year, as we talked about, the tariff tantrum part 2, right? And we updated this just yesterday. The subsequent 12-month return on the EN index from about a year ago is close to 60%. Now, the marker, now again, I know things have calmed down. The VIX is at about 20. But if you look at as a guidepost for those who are more nimble-minded, anytime you go above 30, that's where you could see those returns be quite significant. And again, it's another area that we still have high conviction. We still like it.
And so quick summary from the equity playbook.
Absolutely. This is just a nice recap of everything that we talked about. There's going to be a key, the optionality is going to be key. We highlight the areas of opportunity. The one thing I would say from a takeaway, Rick, is we have a better term of trade, better entry point. But I would also say one thing, just to be anticipatory, small caps have maintained their resilience. We talked about that at the beginning of the year. We would say you still want to rebalance there if you're underweight, given the fact that that's a more cyclical area of the market. Share buybacks have been increasing. So, look, it's painful getting there, but I like when things are on sale. What can I say?